Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name is Manpreet, and welcome to Through the Noise. Now, we're entering a very politically event-heavy season over the next few months, and next few weeks, in fact, are quite interesting from an event perspective. Now, we've recently only kicked off with the first sort of public debate between the President Biden and candidate Trump in the US. And there are several more events in the pipeline in France, in the UK, and indeed in the Middle East that, of course, could be quite significant for markets. So, how exactly should investors prepare themselves ahead of all these events? So, to discuss that and more, I'm joined today by Audrey, who is our head of asset allocation. So, welcome, Audrey. Thanks for joining us today. So, quite an eventful week ahead from a political perspective. What do you think markets will be focusing on?
Well, thanks, Manpreet. And certainly it will be a quite eventful and interesting week going forward. And I think we've seen the first of the event, which is the Biden-Trump debate before the US presidential election in November. And apart from several of the well-known issues, for example, inflation, immigration, China trade tariffs, the focus, in my view, was really on the physical abilities of the two oldest major contestants to ever fight a US election. And I think in this regard, former President Trump appears to have come out on top after the debate, as President Biden wavered at times, when during the debate itself. While the race remains quite tight, history does suggest that President Biden has an edge if the US managed to avoid a recession before the election. However, Biden's chance of a re-election are likely to wane if he fails to lift US consumer confidence pretty soon, based on what we see from a historical perspective. Now, the second event to watch out for is really the France two-round election at the end of June and beginning July, which can potentially cause market volatility, especially if the far-right National Rally Party wins the majority. The market is largely expecting a hung parliament at this point in time, and we do believe that any pullback would offer a chance to add to European government bonds, which is a key area that we like. And then over in the Middle East, Iran is also in an election, and they are likely to elect a president who is aligned with the ruling authorities, therefore sustaining Middle East tensions. And then last but not least, we also have the UK elections coming up. And to me, that's probably the least interesting for markets, given that we have already seen Labour Party having a pretty sizable lead in the opinion polls. So almost quite, a high probability that they will likely win this election. But it remains quite unclear in terms of how they intend to fund their campaign promises going forward. So given these events, we believe that a diversified foundation asset allocation with a tilt towards the US as well as a preference for Indian equities in Asia and some allocation to gold as well will be a prudent strategy in the coming months ahead.
Thanks, Audrey. Let's zoom in a little bit closer on that French election, which will likely to obviously happen over the next couple of weeks. What are the scenarios you see here from a market perspective?
Well, we expect the potential for three scenarios to evolve from the election. One is a status quo, where this scenario is likely to be most positive for the markets as the fiscal concerns will dissipate in terms of a national rally party having a majority. And in this case, French financial markets are likely to see a relief rally, which means that the gap that we see today between France as well as German bond yields would likely narrow. In the second scenario, which is a hung parliament, this will largely be quite neutral for markets, given that in this scenario, there's basically very little prospects of the French government passing any meaningful policies. There will then therefore be a heightened risk of a political gridlock and repeated no confidence votes. And we believe that this scenario is probably quite well priced by markets at the moment. And then last but not least, a cohabitation. And in this case, the National Rally wins an absolute majority and forms a government working together with President Macron. This scenario, in our view, is likely to be perceived quite negatively by markets, at least in the short term. So worries about the fiscal outlook in France is likely to rise, and we might also see France and EU relation deteriorate as well. So this might well result in further downside for French financial market assets in the near term. Having said that, long term, we do expect and believe that this anxiety is likely to fade given that the policy focused under a cohabitation scenario may well center on non-excessive tax cuts, immigration, law and order, which limits fiscal instability. And also in this scenario, what a prime minister can do externally is also quite limited. Plus, if you look at the national rally, they also appeared to have shifted away from its anti-euro rhetoric as well. And if you look at opinion polls today, scenario two has been suggested as a more likely scenario, which means that the current sell-off that we've seen in French financial assets as well as European assets basically represents an opportunity to add to European government bonds, of which about a quarter of which are French government bonds. There are also some opportunities in the French financial sector corporate bonds, particularly in sub-financials. And from an equity market perspective, we are quite lukewarm in terms of French banking sector and see any upside potential as being capped, given that their net interest income is likely to start coming under pressure as the ECB progresses towards further rate cuts.
All right. Well, let's shift gears a little bit. In your first question, you mentioned that we're of course have a small overweight in U.S. equities, and of course we have a preference for the U.S. technology sector. In the sector specifically, where do you see the emerging opportunities?
So we are overweight on US technology, and within which we do expect the AI team to continue powering US technology global equities in the coming months. So far, the Magnificent Seven has been the primary nucleus for this AI revolution, but we do believe that there are also opportunities in subsectors associated with these companies, which gives a scope for the rally to broaden out. For example, there are companies which offers cooling solutions for machine in data centers, and for example, in AI-powered personal computer, which are also potential beneficiaries associated with the AI team. And if you look at AI PC, they are particularly exciting because their current share of the total global PC sales is pretty low at the moment and is expected to rise to about 60% by 2027, driven by replacement and upgrade demand, as well as by AI PC general premium pricing versus regular PC. So we remain overweight the US technology sector and would consider adding on pullbacks.
Thanks. And then my final question on currency markets. I think dollar yen really stood out by breaking above the 160 level. So following that event, do you expect dollar yen to continue to rise further?
Well, dollar yen broke above the prior levels where when the authorities intervened and hit a 38-year high. And it also hit our 3 months target forecast a little earlier than we expected. Although we have seen and heard Japanese equities warning that they stood ready to intervene if necessary, but if you look at the pace of the currency move so far, it might not be enough to trigger an immediate reaction. So if you look at the largest US dollar JPY move from its 28-day low to intraday high on rolling basis over the last 1.5 years, it has been around 9.4 yen. And the latest move that we have seen is about 6 yen. So given this history, we believe that intervention risks are likely to intensify, especially if the pair approaches 164 about sort of levels. And in the event of intervention, history shows that it would not be unusual for the pair to move sharply within a single day. And in that scenario, 157.7 will then likely be a key potential area of support. In the meantime, we are also watching out for the monthly US PCE data, which will be important for the currency market because that will significantly impact the Fed's policy path and the US dollar. And a softer US inflation print is likely needed to keep the greenback under pressure and therefore reducing the need for the Japanese authorities to intervene in the currency market to prop up the yen. Having said that, if we look at US dollar yen on a technical perspective, it does look quite overbought. Therefore, we do believe that the upside is quite limited for now at around 164 as the next key resistance level.
Okay, thank you, Audrey. I think we'll bring the conversation to an end there as we run out of time. Thank you for taking the time for speaking with us today. If I can again summarize maybe my top takeaways, a lot of political events ahead, but looking ahead at France, obviously, if we get more volatility, that of course could be a potential buy and dips opportunity in euro area government bonds. on a currency hedge basis. US technology, potentially also buy on dips opportunity as the AI theme starts to broaden out to more potential beneficiaries. And finally, all of this, of course, we believe makes sense wrapped up in a more diversified portfolio. That, of course, is overweight US equities globally, Indian equities within Asia, and of course, hold gold as a diversifier. So a few key takeaways, but thank you, Audrey, once again for joining today. Thank you, listeners, for dialing into today's call. We look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.